Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Kinder Morgan stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Kinder Morgan transports and stores energy for a fee, usually via a long-term contract. It is one of the largest energy infrastructure companies in North America. It owns and controls oil and gas pipelines and terminals. It owns or operates 83,000 miles of pipelines, 144 terminals, and 700 billion cubic feet of natural gas storage capacity. The company's pipelines transport natural gas, liquefied natural gas, ethanol, biodiesel, hydrogen, refined petroleum products, crude oil, carbon dioxide, and much more. The company also stores a variety of products and materials at their terminals, such as gasoline, jet fuel, ethanol, coal, petroleum coke, and steel. The company has 70,000 miles of natural gas pipelines and is the largest natural gas pipeline operator in the U.S., moving 40% of the natural gas consumed. The company is headquartered in Houston, Texas, and was founded in 1997. It trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Xetra, Vienna, and London Stock Exchange. Let's get started with the model. This is a large cap company, 36 billion market cap. They're trading at $16 a share, and they have 2.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Every year they have a ton of free cash flow. Their lowest is 2.1 billion. It peaks in the trailing 12 months at 4.5 billion. That's a lot of cash flow. That's a lot of dividends it can give back to its investors. Because free cash flow is the cash flow that's remaining after paying all your expenses. So it's the money left over for you, the investor. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty consistent, except for 2020. It looks pretty low. That's probably due to a write-off. Revenue is the sales for the company, and that also peaks in the trailing 12 months at 15 billion. It was lowest in 2020 at 12 billion due to lower oil prices. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaks in the trailing 12 months at 8 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, which also peaked in the trailing 12 months at 4.5 billion. Below that is the interest they pay in their debt. Below that is their other income and expenses. These are all the gains and losses that are not part of the company's core operations. And then you have your pre-tax income, your taxes, and then your net income, which looks good every year. Was low in 2020, mainly due to this large loss of 1.2 billion in other income and expenses. The loss in the trailing 12 months was over 700 million. But the reason their net income doesn't look so bad is because their operating income in the trailing 12 months was so high. But I would just focus on operating income when I look at the income statement, not net income. This is the company's income statement from their latest quarterly report. This shows us the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. They had 3.8 billion of revenue in the third quarter of 2020, up from 2.9 billion. 1.9 billion of services, which was pretty much the same as 2020. But the big jump in revenue was from commodity sales, 1 billion and 1.9 billion. Because as you know, commodity prices, especially oil, was a lot lower in 2020 compared to 2021. Here's a further breakdown of their revenue. Revenue from natural gas pipelines was their big revenue generator, 2.5 billion and 14 million. Products pipelines, all the other commodity products it transports is 605 million. Terminals, where it stores the commodities, 421 million. And CO2, carbon dioxide, is 257 million. 68% of the company's revenue is guaranteed through contracts. That's broken down from natural gas, 43%, terminals, 8%, So that means if they transport natural gas to a customer through its pipeline, it doesn't matter if that customer uses the product or not. They have to pay for it. That's the contract. 25% of their revenue is fixed fee, meaning it does not matter where the commodity price moves. If oil prices go to zero, it still gets paid based on the fee of the contract. Natural gas is mainly composed of methane, and methane is mostly hydrogen. Regular gasoline is composed of carbon compounds. Natural gas produces fewer harmful emissions, such as carbon monoxide and carbon dioxide. So in that sense, it's better for the environment. In case you were curious, natural gas is found in underground rocks. Natural gas liquids can be separated and sold as ethane, propane, butane, and pentane. It is possible a company can be drilling a well and pull oil and natural gas from that same exact well. Most of the natural gas around the world is transported via pipeline, but some of it is transported via vessel. For example, you cannot transport natural gas from Africa to the US by pipeline. It has to be by ship or vessel. Liquid natural gas is natural gas, but they cool it down to negative 260 degrees Fahrenheit. This makes it 600 times smaller than the gas form, so you could transport a lot more. And we use natural gas a lot, every day. In our cars, in our homes, in the products we buy. Natural gas is used to make plastics. Here's a breakdown of their expenses. $1.6 billion from cost of sales, $600 million from operations and maintenance, $500 million from depreciation, depletion, and amortization, $174 million from G&A, $106 million from taxes. Their expenses in the third quarter were $3 billion compared to $2.1 billion. So their operating income didn't go up that much, only from $819 million to $844 million. Their operating margins were a lot higher in the third quarter of 2020 versus the third quarter of 2021. Earnings from equity interest is its earnings in its investments in other companies. That was $169 million. They paid $368 million of interest on their debt, and the bottom line of the income statement is their net income, which was $511 million compared to $472 million. So their net profit margins were much better in the third quarter of 2020 versus the third quarter of 2021. In the first 9 months of 2020, they had $580 million of operating income, but a net loss of $443 million. That's from this impairment and divestiture of $2 billion. The impairment was $1.6 billion in the first 9 months of 2021. I'll show you what that is. They passed through an asset impairment of $1.6 billion relating to their South Texas gathering and processing assets. This was driven by the lower expected rates they're going to get from their contracts in the future. An impairment is when you decrease the value of an asset on your balance sheet and pass through a loss onto your income statement. So it's a non-cash item. Say 5 years ago you bought your house for $500,000, and then you notice the value of your house is $400,000 today. That means the value of your assets or your net worth went down $100,000. That $100,000 loss does not affect you unless you're going to sell your house. Just because you have an asset that went down, it doesn't affect your day-to-day cash flow. The only way it could is if you go to refinance the house or sell it. Then it may affect you financially. But as long as that doesn't happen, nothing changes. Same thing when a company takes an asset impairment or a goodwill impairment or any impairment. It doesn't affect them financially. Let's look at their statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate lots of cash flow, almost $6 billion in the trailing 12 months. A company like this spends a lot in CapEx. They spend from $1.3 billion way up to $3 billion a year. CapEx is investments in property, plant, and equipment. So every time they build out their pipelines, either fixing their pipelines or adding new pipelines, that all goes in the CapEx. Also, when they build out their terminals to store the commodity, that also goes in the CapEx. And these items are carried on the balance sheet and depreciated over their useful lives. Operating cash flow minus CapEx gives you your free cash flow. And free cash flow is the cash that's remaining for you, the investor, So if you invest in a company with no free cash flow or negative free cash flow, that means there's nothing left over for the investors. That's not always a bad thing, as long as the company is growing and will get to the point of positive free cash flow. But if a company always has negative free cash flow, then there's a big problem. This company always has positive free cash flow. That's why it pays a nice dividend. And that's also why they acquire other companies and invest back into their company to grow it. They have been reducing their debt load each year. You can see in the trailing 12 months, they issued $5 billion of debt, but paid down $6.5 billion. So they decreased their debt load $1.5 billion. They decreased it a lot in 2019, over $3 billion. That's another way to give back to investors, by decreasing your debt. Because when you decrease your debt, that's less interest you have to pay in your debt, which means more money flows to the bottom line. They spent $2 billion in investing cash flow in the trailing 12 months. Part of investing cash flow is CapEx, and they spent $1.25 billion in CapEx. That means there's $800 million more in the investing cash flow section. That could be the acquisition of another company. This is their operating cash flows from their quarterly report, the first 9 months of 2020 and the first 9 months of 2021. And the way you calculate CFO, you start with your net income or net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with their net income of $1.2 billion. We add back $1.6 billion of depreciation, depletion, and amortization. Depletion is when you exhaust a natural resource. If you're looking at a tech company, you won't see depletion. But if you're looking at an oil and gas company, you may see depletion. Because when you drill at a location, there's only so much mineral deposits at that location. So after 1 year, you may exhaust the entire location and pull all the deposits. So you may deplete the entire asset. If you deplete the entire asset, you have to decrease the value on your balance sheet to zero and pass through a loss onto your income statement. Depreciation is ideal for something like a car. A car may have a useful life of 10 years, and you depreciate it each year for 10 years. We have to add back $236 million of deferred income taxes. We have to add back that impairment of $1.6 billion. That's a non-cash item. They sold some of their equity investments and they earned money from their equity investments. We have to minus that out here on the operating cash flow section. We receive dividends from our equity investments, so we have to add that here. Dividends are cash items, so we add $535 million. Then we have to adjust for changes in working capital. They bought $362 million of product on credit, so that's a cash inflow. When we pay for those accounts payable, that'll be a cash outflow. They reported an accounting profit of $1.2 billion, but they actually generated $4.4 billion of cash flow. In 2020, they had an accounting loss, but they actually pulled in over $3 billion of cash flow. That's why I like to follow the cash. And you can follow the cash by looking at the statement of cash flows. This is their investing and financing section from their statement of cash flows, the first 9 months of 2020 versus the first 9 months of 2021. In the investing cash flow section, it starts with acquisitions. They had $1.5 billion of acquisitions of assets and investments, a cash outflow of $900 million from CapEx, a cash inflow from the sale of investments. So in their investing section, they had a cash outflow of $1.9 billion. Last year was a cash outflow of $800 million. In their financing section, they added $5 billion of debt. They paid down $6.5 billion of debt. They paid out $1.8 billion of dividends. So in their financing cash flow section, they had a cash outflow of $3.5 billion. Last year was a cash outflow of $2 billion. Let's look at their equity section on their 9/30 balance sheet. They have $31 billion of equity. They raised $42 billion from selling their business, and they lost $11 billion from running their business. Companies that pay out lots of dividends and have lots of write-offs like depreciation may have an accumulated deficit, yet they're cash flow positive. Let's look at the capital structure. They have $31 billion of equity, $33 billion of debt. They're 48% equity, 52% debt. And I gave them the lowest whack on Finbox, 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, That's $44 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $39 billion. We divide that by 2.3 billion shares, and we get a calculated stock price of $17. They're trading at $16, so they're trading at an 8% discount. It's a buy according to the model. Their future revenue is expected to decrease 3% a year. So I decreased their revenue 3% a year. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that comes out to 22%, so I multiplied their future revenue estimates by 22%. That's how I got their future free cash flows. Simply Wall Street is a little higher than me. They're at $19 a share. They're saying it's 16% undervalued. 7 analysts priced this stock and the average price target is $19. The demand for oil and natural gas is expected to increase. This is the 2019 demand. This is the projected 2030 and 2040. Oil is expected to increase even with all the renewable energy initiatives. Natural gas is expected to increase even more, and this company mainly focuses on natural gas. Coal is the only thing on this chart that's expected to decrease. Natural gas is expected to grow 29%, bioenergy 34%. Other renewables is expected to grow the most at 344%. But the demand for other renewables is much lower than natural gas. This is where the stock has been trading the last 5 years. So you can see 5 years ago it was a lot higher, about $23 a share. Oil prices went negative in April 2020, so all oil and gas stocks crashed. It looks like this got pretty close to $10 a share. Then it came way up and dropped way down. But it has come up a lot since then, but it has been regressing the past few weeks. Looks like it's down about 20%. This bottom chart is the price of oil the past 5 years. You can see this stock, like most oil and gas stocks, track the price of oil. It's very similar. This bottom chart is the price of natural gas. There is some correlation with the stock price and the price of natural gas, but not as much correlation as with the price of oil. And they have a beta pretty close to 1, so the stock moves with the market. It's gone up 15% in the past 52 weeks, while the S&P is up 27%. The 52-week low was 13.50, the high was 19. And the stock is on a decline, trading below its 50-day and 200-day moving average. And this is a pretty popular stock. 16 to 18 million shares are traded each day. Of the 2.3 billion shares outstanding, 2 billion are on float. When a share is on float, that means it's available for investors like me and you to purchase. 57% of the shares are held by institutions and only 1.5% of the shares are shorted. They currently pay a dividend of 27 cents per quarter, which is more than double what it paid in 2017 of 13 cents. Their dividend yield is 6.8%, and to calculate the dividend yield, you can multiply their last dividend payment by 4, take that number, and divide by the stock price. So the dividend yield changes every day, because as the stock price changes, so does the dividend yield. And they pay out 135% of their net income. The only reason it's so high is because their net income is artificially low from that large asset impairment. I would look at dividend over free cash flow, and that's 55%, so they can easily cover their dividend payment. Their industry pays a 4.8% dividend. The oil and gas midstream industry is known for paying a good dividend, but their dividend is a lot higher than their industry, and analysts are forecasting their dividend to grow to 7.1%. Their employee count is down from 2015. They were close to 12,000 employees, now they're 10,500. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $7,900 today. That's a 21% loss. But if you own the stock, you don't have to sell. You can just hold on and collect that dividend payment. In the past 3 months, 29,000 shares have been sold. Within the past 3 to 6 months, 67,000 shares have been purchased. Here's a list of the insiders who bought or sold the stock within the past year. This shows the total shares and the price at which they sold or purchased them. So Thomas Martin made a good sell of 67,000 shares at $17 each. 61% of the shares are held by institutions, 27% by the general public, and 12% by insiders. The biggest shareholder of the company is Richard Kinder, the co-founder and executive chairman. He owns 11% of the company, 257 million shares valued at over $4 billion. The next is BlackRock, Vanguard, State Street, and Managed Account Advisors. Let's look at their financial ratios. Their PE is a little better than a market median at 20. PE is stock price over earnings per share. And the way you calculate earnings per share, that's net income over shares outstanding. Their price to sales is really good at 2.3 and a really good price to book at 1.2. Let's look at their non-current assets. They have $36 billion of PP&E. This is net of depreciation. $7.6 billion of investments, $20 billion of goodwill. Goodwill is the premium a company pays when they acquire another business. $1.7 billion of other intangibles and $1.7 billion of deferred charges and other. Their return on invested capital is a bit low at 6%. They do have a lot of debt, but they can cover the interest payments on their debt 2.5 times. Their ROE is 6%, and they have a really low current ratio and quick ratio, both well below 1. Let's look at their current assets. They have $100 million of cash, $1.4 billion of accounts receivables. Accounts receivables are money other companies owe Kinder, and $457 million of inventory. Let's look at their current liabilities. When long-term debt is due within 12 months, it's put into the current section of liabilities. They owe $2.8 billion on the current portion of their long-term debt. $1.2 billion of accounts payable, that's how much Kinder owes other companies. And a few $100 million of accrued interest, accrued taxes, and accrued contingencies. They had $4.5 billion of free cash flow in the trailing 12 months. They have negative $3.1 billion of working capital. Working capital is current assets minus current liabilities. And they paid out $2.5 billion of dividend payments. So they're short over $1 billion. So it looks like they're going to need some debt financing to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 61 companies in the same industry as Kinder, and this is the average of all 61 companies, and Kinder is right here. Their debt to equity ratio is 1.1, the average is 2.4. Debt to equity ratio is liabilities over shareholders' equity. Generally, 1 to 1.5 is considered good. When the debt to equity ratio is above 1, then a majority of the company's assets are funded with debt. When it's below 1, the assets are funded by equity. You don't want a debt to equity ratio too high. 1.1 is really good. The average dividend yield is 5.9%, they're 6.6%. Antero pays 11%. Magellan pays 9.4%, and so does MPLX. Their dividend over free cash flow is 44%. If it's over 100%, that means they're paying out more in dividends than free cash flow. Enbridge is almost 300%. It is possible they spent a lot in CapEx in the trailing 12 months. That's why it's so poor, their dividend over free cash flow. And the average free cash flow for the trailing 12 months is under $900 million. They're at $5.5 billion, a lot better than average. Energy Transfer is at $8.2 billion. Of the 61 companies in their industry, they're fourth highest. Enbridge is number 1 by far. Their price to book is a lot better than average. Their price to earnings is worse than average at 20, average is 17. Their price to free cash flow is also worse than average at 6.4, the average is 2. Their price to sales is a little better than average at 2.3. Their revenue is much better than average at $15 billion, average is $6 billion. Their annual revenue growth for the past 5 years is only 3%, average is 7%. Look at Cheniere, 68%, that's pretty massive growth. Their return on assets is 3%, the average is 3.8%. Return on assets is net income over assets. 5% is considered good, 20% is considered great. But you always want to look at ratios comparing to companies in the same industry, not to the entire market. This tells us how profitable the company is in relation to their assets. ROA factors debt into the equation. ROE excludes debt. Their ROE is 6%, average is 9%. Look at Cheniere, 357%. And that's the best ticker, LNG. They got the best ticker, LNG stands for liquefied natural gas. But you always want to look at ratios over a long time frame. If Cheniere has 357%, but in other years it's negative, then that's not so great. So to summarize, I have them trading at an 8% discount. They seem to be doing really well, putting up great numbers. And midstream stocks are pretty stable investments. It's much less risky investing in a midstream company compared to an upstream company. Upstream is the most risky because they actually pull the oil. So there is a chance they spend tens of millions of dollars trying to extract oil from a location and do not get any. Midstream just transfers the oil from one party to another. So there's very little risk for midstream companies. But when you invest in an upstream company, you do have the potential to 10, 20, 30x your money. Midstream, it's a pretty stable investment where you're probably going to get 5, 10, 15% return a year. I rank their free cash flows 9 out of 10, their revenue 9 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.